EBITDA Multiples, the gold standard for valuation in middle market and lower middle market deals. I'm Arthur Petropoulos, managing partner here at Hillview Partners. We're a middle market, lower middle market, M&A and capital advisory firm, helping primarily privately held family, entrepreneur, small investment group owned companies generating $1 million to $10 million a year in pre-tax profit, sell themselves or secure capital. So in today's video, we wanted to talk a little bit more about EBITDA multiples, and we'll put some thumbnails in here of all the videos we've discussed this with in the past. We want to talk about it at a slightly different angle here. We've talked about valuation of companies and how is the value of a company determined. We've talked about some of the more academic kind of internal rate of return or discounted cash flow types of analyses. But in reality, in the middle market and in the lower middle market, the gold standard of valuation is primarily going to be an EBITDA multiple. And there's really two reasons for that. One being kind of the implicit quantitative elements that it implies, and the second being more kind of the practical implications of why this is relevant or how it bakes into the overall transaction process. And I know that sounds a bit opaque, but we'll dig more into it and it'll make a touch more sense. But for item number one, let's look quickly at the EBITDA, call it yield implication. So someone buys a company for 5 times EBITDA. It implies, for round numbers, a 20% annual return, right? If you pay $5 for $1 of earnings, then those earnings every year, assuming they stay the same, will be 20% of the initial purchase price. Now, the actual way deals come together, and if there's leverage or financing, and what's the actual equity contribution, and there's obviously cash flow along the way, and if the exit value is something more than what the incoming value is, there's a lot of things that maneuver that differently, but very, very high level, think of it that way. What is the implied yield? And again, as we've discussed in prior videos, what does that implied yield mean in terms of a incremental return over the risk-free rate? A very complicated way of saying, if you get 4% on a treasury bond, I need to make a lot more money to want to invest in a privately held business. And so if I buy a company at 5 times EBITDA, it implies a 20% return, which most people would indicate is an acceptable incremental return over the 4 to 5% treasury bond of a similar duration. So take that as the baseline understanding relative to valuation. If you buy a company for 10 times EBITDA, you're effectively implying a 10% annualized return. Again, lots of other variables that go into these things, and when companies actually underwrite, if you will, to a return, they will bake into the incremental cash flows. They'll obviously take away some of the costs relative to financing and transactions, and they will imply some sort of a bump in terms of the exit of the business, but very, very high level. Let's keep that as a foundational concept as we continue with this analysis here. And so pivoting to the second part is, what is the pragmatic application or implication, if you will, of an EBITDA multiple in a business? And really what that gets into is the idea of multiples expansion and the food chain, if you will, of institutional capital. And so what we mean by this is private equity, in large part, if you want to really boil down what does private equity do, they are buying lots of companies typically, and when you hear these roll-up strategies, aggregation strategies, consolidations of fragmented industries, they're going around buying lots of companies that do similar, adjacent, complementary things for, again, similar, complementary, adjacent geographies, so say industry, product, geography, as we've discussed in prior videos, but they're aggregating lots of things. And the idea is that they can go around and they can acquire these things at, say, an implied 20% yield, and therefore perhaps 4 to 7 times EBITDA, maybe a little bit more for certain situations, and perhaps a little bit less if it's more of a distressed situation or an unrepresented situation where they don't have someone like us representing them. But in lots of situations, you can think of the private equity model as going around and buying a lot of different things at 6 times, and then when you have enough of these things together, selling the whole thing for 12 times. And so, as we've discussed in a high-level example in the past, if you went around and you bought $10 million of aggregate EBITDA, so maybe you bought 10 $1 million EBITDA companies at 6 times EBITDA each, you would spend $60 million on this aggregation of $10 million of earnings. You basically bought the 16 2/3 implied return on your capital. However, when you go out to the market to sell that aggregated, and again, it's no easy feat, and give great credit to private equity for being able to integrate all of these companies and to streamline things, but assuming, even if you just take the high level that they just push everything together and it stayed exactly the same, they would have $10 million of EBITDA that they could then go out to the market and sell for 12 times EBITDA, right? And so you bought all of this stuff for $60 million, and now you're selling it for $120 million. So all other things equal, purely the size or the aggregation or consolidation will warrant a larger price or a higher multiple, which creates value. And so people will say, why does this happen? Why do they pay so much? And I've heard some really lousy explanations of it along the way. As much as I like Alex Hormozy, his idea that, well, private equity is lazy and they don't want to go around buying these small things is not true. In any ecosystem of business, there are countless people that are certainly not lazy and are working every little angle they possibly can to squeeze out and extract as much value as they can. So what it really comes down to is not just laziness or randomness, but truly a matter of mandate. And what we mean by this is the mandate of a private equity firm is to deploy capital and is to generate an adequate return without losing money. When we say adequate return or satisfactory return is the phrases you'll hear, their mandate is to generate a return. So let's just say you have a school endowment or pension that invests in a private equity firm to generate them a return of 12% a year. For larger private equity firms should generate 12% a year. For smaller private equity firms should generate 20% a year. Then those private equity firms' mandate is to go out and buy companies and undertake this exercise of consolidation, aggregation, however you want to look at it, and improvement of companies such that they can generate those returns and to deploy capital. Now, when a private equity firm raises capital, they have to deploy that capital. And so if they are in the business of having a $200 million fund, they need to deploy all $200 million. And that could be lots of different $10 million checks. Similar for a multi-billion-dollar fund. Again, they're deploying it in lots of deals. And so it's not a matter of laziness, it's a matter of meeting their mandate, of being able to invest the capital at an adequate return, but to actually be able to deploy the capital. And such, if you think of it from an entrepreneurial perspective, if I'm going to buy this company and I'm going to make as much money as I possibly can, and we're going to take all the risk in the world to do that, as many entrepreneurs must, and that's why we love working with them, it's a very binary outcome oftentimes. The business is either going to be successful or it's not, and it's going to be a failure. The private equity mandate, on the other hand, is not to buy things that have a binary outcome. Now, you can make the argument that venture capital is more oriented in that way, but for traditional private equity, it wants to buy things that have an asymmetric return profile in the sense that it could have quite the upside, but it's going to have limited downside. And so they're not buying companies to say, we're going to swing for the fences here and either hit a home run or strike out. They're buying companies to say, this would be nice if it's a double. This could be nice if it's a triple. Then if you really think of the food chain, you say, okay, I'm growing this business from nothing to something. The business then sells at 6 times EBITDA to a private equity firm that buys 10 of these similar companies. And then that private equity firm takes that $10 million of EBITDA and sells it up the food chain at 12 times. Now that distinction, that EBITDA expansion, the multiple expansion, is the product of that next firm having a lower cost of capital because, again, they're buying something bigger, so their risk tolerance is going to be less, but the return they have to generate for their investors is going to be less as well. All of these pensions and endowments, a very specified breakdown of how they deploy capital and what returns they expect from what pockets of capital. And so for large private equity, they may be saying, look, we're going to generate a 12 to 15% return net of fees to our investors, and therefore they're not out there swinging for the fences. They want to buy sure-shot things. And what is something that defies risk or mitigates risk oftentimes? It's size, it's establishment. So they're not going to go wanting to buy a bunch of very small companies that have a lot of risk. And so as the companies get bigger, presumably the risk profile gets lower, and therefore it's more comfortable for private equity to deploy capital at lower costs of capital to generate their returns in their mandate at the right risk profile for their investors. And so that's how you really want to think of how companies kind of start in this embryonic stage and then work their way up this food chain where risk comes down, cost of capital comes down, multiples go up. And so if you think of publicly traded companies that are trading at even higher multiples, it's because, again, the implied risk is lower. And it's not to say that there aren't publicly traded companies that go bust or that things happen, but again, think of the food chain, think of the mandate, and it makes a lot more sense. And so at the end of the day, the EBITDA multiple is the gold standard of valuation, particularly in deals that we're working with, because it is basically the underpinning logic of why the companies buy things, of their thesis of multiples expansion, and of the implied yield or the implied rate of return that each party along that food chain necessitates or requires to both do their business and to fulfill the mandate of their investors. And so that's the thought for today. The idea being of how do we tie together all of these concepts relative to EBITDA? Why are there other kind of more academic analyses of returns, but why is the EBITDA multiple the one that you'll hear the most and the one that's kind of utilized most ubiquitously as the shorthand for how deals are valued? And these are the concepts. Think of the implied yield on one hand, and think of the practical implications of the private equity food chain and the institutional capital food chain more broadly. So that's the thought for today. Hope the week continues to go well for everyone. Keep pushing forward. God bless. I'll see you everyone next time.